Hey, welcome back to the channel. Today we do a follow-up to the previous episode in which we started talking about various types of life insurance policies. We'll look at numbers. We'll try to see how premiums can change based on the type of policy that you decide to use. We'll take a look at a regular term, a term with living benefits, a term with increasing premium or increasing term like I like calling it, an index universal life, a regular whole life, a participating whole life, and a final expense policy. I do understand that this could be overwhelming, especially if it's the first time for you to see this type of table. So bear with me. I'll try to direct your focus where it matters. I should also mention that to establish a fair baseline, we'll look at a 34-year-old male trying to get a $500,000 death benefit, with the exception of the final expense policy that will only cover for a $50,000 death benefit. If you look at your screen, you'll see that for a 10-year coverage, the payment will be $163 per year, which is pretty cheap. If we move to the other side of the spectrum for a 30-year coverage, the premium will be $398. Another important consideration when looking at term policies is that you have the option to renew the policy, but then the premium that you will pay will be significantly higher. For instance, if we look at this column, you'll see that all the way up to age 58, you will pay a level premium, meaning the premium is not going to change. It's going to be $326. But then when you turn 59, if you want to renew the policy, payment will jump from $326 per year to $5,452. So I highly advise that whenever you use a term policy, you make sure to keep track of how long you'll be covered, and you start putting in place plans for what happens when the policy expires. Next, taking a look at the term with living benefits, you'll quickly realize that it's pretty similar to the regular term, with the difference that it seems to be a little bit more expensive. And the reason is, now you can access part of that benefit while you're still alive. So for instance, in this case, for a 10-year coverage, you'll pay $191 per year. And for 30 years, you'll pay $526. Now, if I have to choose, I will most likely choose a term with living benefits, because I know that while there is an increase in the premium, it's not that big. But on the other side, I get to access part of the death benefit if I ever qualify for a terminal illness, critical illness, or chronic illness. The first thing that you should note here when looking at the term policy with increasing premiums is that, like the name suggests, premiums increase every year. Looking at this column, total scheduled premiums, you quickly see that every year it's expected that the premium will increase. On this table, you should also note this column, maximum. So this column represents the maximum increase in premium that the insurance company can do per year. And why would they do that? So it could be the case that on a given year, the insurance company had made some projections of, let's say, the number of claims that they will have to pay. Maybe that year they ended up paying more death benefit than anticipated. It could be the case that they need to raise more money, so they have the right per contract to increase the premium to the maximum specified at that specific year. Going from 2023 to 2042, you'll go from about $300 to about $1,300 per year. Let's look at what happens when the individual turns 79. So in 2067, you will see that the scheduled premium is about $12,000. If this still seems to be manageable, look at the maximum. The maximum can rise up to $60,000, which is a very huge number. And this is why I always emphasize that whenever you get a policy, it's important that you take the time to read through the document. Even if you don't fully understand the terms, at least look at tables and make sure that you're fine with what you see. On the other side, a benefit of this policy is that this term policy covers up to age 80, which is far beyond the 30 years maximum coverage that you usually get with regular term policies. For a death benefit of $500,000, the premium is set to be $4,120, which is a different scale when compared to term policies. In addition to the death benefit, in permanent policies, you usually get living benefits, critical illness, chronic illness, terminal illness that you can add to the policy, but also you get to build cash. So you see this column, cash surrender value. So this cash is part of the building blocks of these policies. So as you pay premiums over the years, you're also getting some cash as a form of equity. For illustration purposes, I assume that every year you will make a return of 6%. But in practice, that will not happen. So whenever you look at an illustration, particularly in the case of permanent policies, we try to guess what the future could look like. The illustration that you see is just one scenario among millions of possibilities. So for instance, if in the first year we make 6%, the second year we make 10%, the third year we make 3%, this is already a totally different scenario, which will not reflect in the numbers that we see. So the most important thing is not necessarily the numbers, but understanding the mechanism. So now if we scroll down to age 58, you will have paid $103 in premiums. If this scenario unfolds as anticipated here, you will have a cash value of $155,000. Now we have guaranteed values. So if you paid $4,515 per year, you are guaranteed to have this cash. For instance, here by age 60, if you keep paying these premiums, you are guaranteed to have this death benefit of $500,000 and a cash value of $145,000. What is the difference between a regular whole life and a participating whole life? You get dividends at the end of the year. At the beginning of the year, the insurance company is going to make a budget. They will account for operational expenses. They will try to guess how many death benefit they will have to pay, and so on and so forth. By the end of the year, what is left over of that budget is shared among the policy owners in the form of dividends. For this policy, you will pay $7,690 per year. You have the guaranteed section here that basically works as what we have in a regular whole life. For instance, by age 57, you are guaranteed to have this cash value in addition to the death benefit. If you take into account the dividends and you use those dividends as additional premium, now by age 57, you will have this cash value, which is a lot bigger. And on top of that, the death benefit will increase to $757,000. The reason why this side is non-guaranteed is because we can't guarantee these dividends. Here, the insurance company is just guessing what the dividend could be in future years, but in reality, we don't know. Just like in an IUL, we cannot predict what will be the return every year. In a participating whole life policy, we cannot also guess what will be the dividend in the future. So the insurance company is just making its best guess. Final expense policies are not designed for you to leave a significant pile of cash to your dependents. It's more designed towards paying final bills, things like funeral, remaining medical bills, and so on. So that's why the death benefit is not usually that high. So you'll see in this case, I have a death benefit of $50,000. And for this $50,000, I'll have to pay $1,124 per year. In addition to the premiums that I'm paying and the death benefit that I'm getting, I will also get some cash that will accumulate, but this cash is not going to be that significant. With a regular term for 30 years of coverage, you will pay $398. A term with living benefit, you will pay $526. A term with increasing premium, we cannot classify it because the premium increase. It starts with a premium of $306 and can range up to $12,000 a year. We also have a maximum that expands how much premium we can pay. For an index universal life, you'll have to pay $4,120. For a regular whole life, we'll have to pay $4,515. For a participating whole life, we'll pay about $7,000, and for a final expense, we will pay about $1,000. I hope that you found value in this episode. If you did, please make sure to like and subscribe. If you want to talk to me in a private setup, please check the description below. You'll find a link to my calendar where you can book a free 30-minute consultation. Between now and my next video, stay safe.